Ladies and gentlemen, the banking bros are back here at the Cash Compound, and we are talking about an investment opportunity where we're going to break down the numbers for you. Here we go. Welcome back to the Banking Bros and the Cash Compound podcast here. It's Jonah and JDew, and what we're going to do here on this episode is break down for you how we made money investing our cash value from our policy. Jonah, it was a newer thing for us. When we got into this game, I think you and I were talking about the opportunities to be able to buy our own houses, get out of debt and things like that. But you know what we realized is the math is mathing so well. Let's get into the game of investments in the last couple of years.
That's right. I think one of the things, I mean, most people, right? I would say the average American, right? At some point they go, I want to do something. I want to do whatever it might be to make money, right? And so one of the things that we've stepped into recently is kind of this private lending aspect.
Yeah.
There's an opportunity to make money there. So we actually recently did a private lending deal. You might have seen that actually in one of our other videos posted just earlier in the week, new investment opportunity. If you haven't watched it, go watch it, because that's the opportunity we're going to break down in this episode. So we're going to talk about why we did it. We're going to talk about the deal specifically. We're going to talk through the numbers. We're going to do everything. The math, right?
So what we want to help you guys understand is when you have that green cup 2 cash value that's available for you, you can do whatever you want with it. That's what's all about. Cracking the code to cash flow is this money is going to flow towards you and give you whatever you want out of life. Money should be moving and it can bring you all sorts of opportunities. The opportunity we wanted to go for here was an investment. So we said, why don't we use the cash value, OPM, other people's money, the insurance company's cash value for us within our policy that we can control for an opportunity to leverage on an investment. The policy is not actually the investment. Some people think it is.
That's right. So that also means that our initial deposits into the policies are still growing. Right? Those were not interrupted. We didn't touch those. No withdrawals out of the policy. We took a loan from the policy and we were going to use this loan to go do the investment. So if you've seen the other video, maybe we'll put that investment specifically in this video as well. But the opportunity was a house purchase.
Yes. So
and again, this is someone else. We're not doing the house purchase. We were going to fund the money.
Yeah. So we've recently actually run into a lot of people in our neck of the woods who are real estate flippers, developers, creative finance people, Sub 2. Shout out to Pace Morby, Jamil, and some other folks. I got to meet them recently.
Yeah.
And so we have folks out there doing deals and looking for what's called private money. Well, we had some. It's our money to be able to use. And so let me read off some of the specs, shall we, on this deal. So it's a single family home in our neck of the woods. We live in the northwestern corner of South Carolina. It's called the Upstate. And right in our town, there's a single family home that needed some improvements. Our buddy probably did a great deal with someone who wanted to get it off their hands. And so what he needed for this deal was $100,000. He needed it this summer, and he was going to give an interest rate return to the private lender of 15% annualized. Now, he believed he could fix and flip, resell in about 2 months or less. But that's what he was asking for.
Right. So on that basis right there, let's just do some quick math, make sure everyone's following. If you give someone $100,000 and they're promising 15% annualized, that means at the end of the year, it would be a $15,000 profit.
You guys got that math, right? Math is mathin' so far.
It's easy math because it was a flat $100,000. So
easy.
It makes it a lot easier. But that's the deal. And again, he believed he could fix and flip faster than a year. In fact, he thought he could do it in like 60 days.
Yes.
And because he thought he could do it in 60 days, he said, well, I'll at least pay you the 15% for 3 months. Like if I get this done faster, I'll at least give you 3 months worth, which of course incentivized us to actually give him the money.
Yeah.
Right.
Yeah. So it's actually, he said minimum return right here is 3 months of interest, $3,750. Everybody got that. So that's 15% annualized. He thinks he's going to give us minimum. I'll give you the 90-day number, $3,750. I think I'm going to return it back to you faster than that because I feel really good about this house. It looks like it's we should look it up here. I don't know if I can see it here. What were the specs on the house, Jonah?
I have no idea.
So the specs on the house, where I'll look it up maybe while you talk a little bit here.
Okay, no worries. So that was kind of the original deal and process. So let me walk you through exactly what we did. So first things first, we need to now get $100,000. We need to give it to him, right?
Yep.
So surprise, we didn't actually have $100,000 inside of one policy. We had $100,000 spread between like all of our policies.
Yep.
So we called our companies and said, hey, we're interested in the loan. So we, how many policies? So I think I borrowed money from 4 policies specifically.
I borrowed money from maybe 4 as well.
Okay, cool.
So let's just assume it was 4.
So we've got 8 total policies, but the cash value in those 8 total policies equals $100,000, which is what we needed.
So some people want to know, once again, Jonah, like, what's the process for borrowing this money? How quick did it come?
Sure.
Do you have a hassle?
So specifically, I think you probably called, right? I don't think you like to do paperwork. So did you call or did you do paperwork?
First off, yes, I always call. I don't like the paperwork. Okay. So I call customer service and I said, hey, let's assume for these 4 policies that I took it from, maybe because we both have more than 4 policies. So let's assume that I took max loans. So it's a term that they like. So they just know, give me everything I can possibly get out of this particular policy. So I did that 4 times, probably on 2 different calls, because I have policies from 2 separate companies that I called from. I do know that. So 2 calls. Hey, this policy, max loan, send it to my house. I'm a direct deposit type of guy. So that's how I got it. Maybe even a wire. I don't know. And I did the same thing with the other call. So it's 10 minutes of calls.
Yep. So I did not call. I think it's a little easier to do it online personally. So I logged into one particular website. I clicked the button to send the loan. That website, that company was done. So that was one policy. 3 other policies were with a different company. And I wanted to get max loans on all 3 of those policies. So I actually put all 3 of them on the online platform. I typed in the number, this policy, this policy, this policy. I checked max loan and I hit submit. So that's what I did to get the money.
Love it.
And then again, sometime in the next week, the money showed up from all 8 policies, right? Mm-hmm. So we've got the money. And so then we've got to send the money over to this person who's going to do the deal. So we wired the money over to the person.
So day before the transaction was supposed to be finalized at a local real estate office. Remember, this is local. So it was a collateralized deal. This house is 3-bedroom, 2-bath in our neighborhood. We can go look at it and that type of thing. So we're legally doing our due diligence with our buddy and doing it on paperwork. But so day before the closing, we go to wire it over. Actually, that was literally the day that we had our baby. So it was actually very complicated for me to go do it because I think, were you out of town? And then I had a baby. I don't know. Yep. So I had to go do it, and Wells Fargo out here ain't getting no shout outs.
Yeah. So if you guys have ever wired money, you understand you can't really do that online. You can call over the phone, or you can go into the bank. I think you went into the bank just because
went into 2 branches because they ain't got their act together over there that day.
Wells Fargo wouldn't do it or something.
There was not the right notice. So we had $100,000, which needed an extra signature, and that person's at lunch and blah blah blah.
So 2 different banks. So Wells Fargo was our hardest part of the transaction so far.
Yes.
You right?
Yes.
Okay, cool. So we finally get that done. That means the person's got the money. We got a promissory note, of course, signed by both parties. We've got hazard insurance that shows up in the mail, right? We've got all our documentation. Yep. So we got lots of stuff moving, but the important part is we gave them $100,000.
Yep.
Then, so that was actually in May, the end of May.
It was the end of May, right at the end of May.
So July, so this is only, 45 days, if that?
Sure.
Right? I think he sends an email out that says everything's going according to plan, and you'll actually have your money back on the 15th of the month.
So he sends us a update, and we get a call from the real estate attorney's office because we have a lien on the property. So for those of you who are into the private money game, you might know that in the event he doesn't do great and something goes down, we have first position on the mortgage. Some of you know what that means. We were kind of new to it. So first position on the mortgage means, which we understood, if something goes bad, we would inherit the property. Now remember, this is a 3-2, 1,400 square feet in our town. Halfway through a fixer-upper situation, we could inherit the property, rent it ourselves, move in if we had to or whatever. So that was a good deal for us, and that's why we knew this was a vetted idea for us. This is going to be a great deal because even if it goes down incorrectly, we got a house in a neighborhood that's up and coming in our.
Yep. So we get the money back on like July, middle of July. We get the money back. Gave him the money in May, get the money back middle of July, because that wasn't 90 days. He paid 15% for 90 days as promised. So that means when we got the money back, we got $103,750.
We just got recouped all of the money we sent out. We're the bank. So when we charge interest, we've charged him this $37.50. That's what he's paying. We have recouped our money. We have it again. Our money got busy for us, went to work for us, and brought us home an extra $3,700.
That's right. That's how that worked. And then, of course, what we did with the money is turn around and pay back our policy loans right away. So I currently have 4 policies where the loans are completely repaid. Why? Because I took 4 loans from those 4 policies. And when the money came back, I put it back. I also made additional money, right? We ended up splitting it because we both used money.
Right.
But I also made additional money. So I now had even more money to go repay a different policy that had a different outstanding loan for a different reason.
And
right?
Yes. And so also remember that when you had the extra money, when I got my, let's say $1,500, he got his $1,500, I got my $1,500 extra back. If you want to put that back in the policies to pay yourself back with interest, which is rule number 2. Rule number 1 is pay yourself first. We had policies going for us, growing for us. We took $100 from our cash values, borrowed against our policies, and we put back more money. We put back that extra money. We actually put it into the bucket, the cup that we're always saying, that is premium deposit. So we returned the bank's money, and our bank needed $100,000 back. We put the extra into the pool of money that pays the premiums, where we put our money. Hopefully you guys get that differentiation. We paid back the green cup, if you've seen our visuals, and we put extra money in our red cup.
That's right.
And that makes the whole thing go and grow even better.
Which means we have all the money back, so we can do a totally another deal tomorrow if we wanted to. And
Love it.
We have extra money growing for us, which means the next time we do a deal, we can do a bigger one.
Let's go.
Which is really fun. So the reason we're kind of pointing this, and we're going to dive into some numbers specifically here, but if you haven't seen our YouTube video that recently posted earlier this week, it's called New Investment Opportunity. It's got these numbers broken down on screen so you can see it. And we compare and contrast doing this same deal out of our own pocket or doing this same deal from our policy. And we talk about why using our policy would make you more money. We talk about tax implications. You make all this money back, you have to pay taxes. If you make this money back from using your policy, there's a difference there. There's a caveat, and we talk about that as well, and how using your policy actually makes you more money than if you did the deal out of pocket. A lot of people get that confused. They just assume, well, if I use my policy, I have to pay it back, so I'll never have all the money. I'll make less. It's just not the way that money actually flows, which is really important for you to go and watch that last video.
Yep. So we'll link to it right below as well in our YouTube series. So remember, shout out to everybody watching us on YouTube. We've got our podcast and all your favorite streaming platforms, but we also have the YouTube visual video of this recording as well. So Jonah, let's get into the numbers, shall we?
Shall we? Yeah. But before that, let's give a shout out to specifically to our fan follow of the week. And our fan follow of the week is Tanya Potts. Tanya Potts is following us on YouTube. Thank you so much for doing so. She's a recent follower, subscribers on YouTube. Yep. And so if you're watching, leave a comment so we know you saw it, and ask a question or two. We'd be more than happy to answer. Tanya, thank you so much for spending time and energy and effort with us. But yeah, let's dive into some of the numbers. So basically, let's break down the same way we did in our last YouTube video. So basically we've got $100,000 that's going out to the investor, right?
Yep.
And then we're going to get a return of 15% annualized. So for an instance, let's just say instead of having the money returned to us in less than 90 days, let's say we made it all year. That way we can keep the numbers simple for the people who are listening at home.
All right, let's do it.
You have 15% that you're going to make on $100,000, and the money was there all year. You're going to end up making $15,000.
Gross profits.
Gross profit.
Yep.
Now, when you make $15,000 $100,000, you're going to have taxes on $15,000, right?
Uncle Sam's coming for his
Uncle
share.
Sam's coming for it. So if you use $100,000 out of your own pocket, then you make $15,000 back. Again, you get your 100 back, of course,
right.
but you made $15,000 extra. Uncle Sam's coming for you, right?
Yes.
So let's assume you're in a tax bracket that's going to charge you about 30%. I understand you can be in a different tax bracket, but
We're trying to do easy math on the podcast.
So it's not going to change the fact if you're in a 20% tax bracket, because we're going to compare the exact same
Equivalent
tax bracket.
equivalent tax
So let's
bracket.
just say you're in a 30% tax bracket. So what we've got there is 30% of 15,000, right? That's going to give you, if my math is serving me right, I think it's $3,500 that you're paying in taxes. Does that sound right to you?
I think so.
$3,500. Let's get the calculator up just to double check it. So $15,000, we're going to times that by 30%. $4,500.
45.
We're almost off. $4,500.
Okay.
Yeah, $15,000. You subtract it by $4,500. That's going to give you a net profit of $10,500.
Got it.
So $4,500 is going to Uncle Sam. You're keeping $10,500.
10,500.
That's the end of the equation right
Done.
there. That makes sense?
Yep.
Instead of making 15, you make 10,500 because you got to pay taxes.
Yes.
Okay, cool. Now let's do the exact same scenario, but use your banking policy to do it. So first things first, you got to get them $100,000 out of your banking policy, right?
Yes.
Okay, cool. That's the same.
Now, how do you do that? Which brings us to our comment of the week from Travis Ray Price 5 on TikTok. What up, Travis Ray Price 5? We're trying to answer the question here when we are going to give $100,000 out to this investment opportunity, and we paused because you gave us this comment in the DMs on our TikTok at The Banking Bros. Hey, how does the insurance policy work where you can withdraw from your death benefits? I've been seeing a lot of content on the subject and would like to learn more. Great question, Travis. Appreciate you guys following us out there. So reminder, everybody, what we're doing is we're borrowing against the policy. We're borrowing against the death benefit. The number that's available is called your cash value, ladies and gentlemen. So when we're talking about taking money and borrowing against your policy or borrowing against the death benefit, there is a title on that money. It's called cash value. It's the equity so far of your death benefits that have to be paid out. This is whole life insurance. It's guaranteed. So back to our story, we decided to pull or borrow or take 100 grand from our cash value, which would temporarily, as long as it's outstanding, lower our death benefits by that same amount of money. Travis Ray Price 5, hopefully that answers your question. Appreciate you with our comment of the week.
Yeah, so let's keep moving. So we borrow $100,000 out of our cash value, give it to the investor, right? That's the same thing we did on the other side, out of our pocket. But because we borrowed cash value, we are always going to repay that cash value. When we decide to repay that cash value, we can repay at any interest rate we want to. We're the bankers.
Right.
We're in charge.
Yes.
So let's just use a 10% interest rate because, again, it's a round number for
And
everybody.
we do 10% all the time. Yeah. It's real, ladies and gentlemen, and it's easier to track. 10% is a nice number.
And it's a round number for all those who are listening at home, not watching on screen, right?
Yeah.
So if you're going to take $100,000 out of the policy and charge 10%, I'm charging 10%. It's my policy. I get the money. I can use it however I want. I'm charging 10%. What that means is I need to put in $110,000 back when this is said and done.
Yep.
Right?
Yep.
Okay. So they got $100,000. The investor, they pay 15%, which is $15,000. Same deal, right? Except this time I've got to repay my policy with an extra $10,000. So I'm not just putting $100,000 back in, I'm putting $110,000 back in. That leaves me with profit of $5,000.
Yes.
Now I've got to pay taxes on my profit, right?
Pay taxes on your profit. Now the reason we're not paying on the whole 15,000 is
because we had owed 10,000 back in interest.
Even though it's your own policy, ladies and gentlemen, we have paperwork that says we borrowed this money and owe 110 back. So that 10 grand is not what is our taxable gain.
That's correct. It's not personal interest income, which brings us to another comment from Caesar H on our last video where we talk about this. He says, assuming the IBC, the infinite banking concept, the policy policy has loan interest at 5%, wouldn't you have to declare the other 5% as personal interest income to the IRS?
Ooh, great question.
And the answer we just kind of answered is no. You
No,
don't have to.
we had a loan out.
It's not
We
income.
repaid the loan.
Loan interest is not income personally. It's loan interest, right?
Yeah.
So I paid it back. So that leaves me with $5,000. I made 15, 10 of it had to go back to the policy that I own and control. 5 is left. 5 is income. Well, I've got to pay income on 5 then.
Yep.
Or I have to pay taxes on 5.
Taxes.
30%. We were in a 30. That's what we did in the other side, right? 30% of 15,000 is 4,500, but this time it's 30% of 5,000, which is only 1,500.
Yes.
Right?
Yes.
1,500. No calculator needed. I knew that one. Okay, that leaves us with $3,500 as profit. But wait, there's more. You also get the $10,000 that went back in your policy because it's your policy and you own it.
Remember, the $10,000 that went back inside your policy is now growing alongside of all the previous premiums you ever put in there. You don't just get the loan interest you charge yourself. You get whatever it grows to forever for the rest of your whole life.
That's right. So if you look at the kind of blanket values right there that day, it's $10,500 is how much you make after taxes if you pay out of your pocket. Or if you use your policy, you'll actually make $3,500. That's your net income after taxes outside of the policy, plus another $10,000 that's now in the policy. That's $13,500 plus any growth. Right?
For the rest of your life.
Now, we won't count that. Let's just look at
we got to count it. We got to
Let's just look
count
at
it.
the flat value.
Right.
10,500 or 13,500.
Which number is bigger where you come from, ladies and gentlemen? We hope that you understood this. Obviously, it's a lot of words, and some of you like to listen to us while you drive. We know we have a lot of truckers out there, actually, who are part of our community.
It's nice to be able to listen to something while you drive on the road.
So hopefully that is helpful. But remember, we've got visuals waiting for you whenever you park on the side of the road or you're not on the treadmill. So that's what we wanted you to understand about how you can utilize your cash value, borrow against your policy to actually go do investments. This policy is going to go and grow and be available for you as cash flow. So why don't you use someone else's money while you saved yours to go make great gains? That's what it's all about here. Cracking the code to cash flow, ladies and gentlemen. Hopefully you have enjoyed our episode. Jonah, hit him with one more quote.
T. Harv Eker said, "It's simple to master money. You just must manage it."
So that's what we help people do when they become their own banker. We'll walk you through all those steps if you'd like to work with us here at the Banking Bros. And we look forward to chatting with you very soon on a one-on-one free consultation call to help you get started with infinite banking.